People always think they need 20% to buy a house, and you don't.
You quit your job when you had your third baby on the way.
So we actually gave my notice, and then we found out we were pregnant.
Pre-approval versus approval.
Even taking $5,000 out on a credit card could decline the deal.
Why do you think that would impact?
Now you've added a liability that was not there anymore. You go start house shopping. You also went and bought a car. Car loan kills the ratios.
Ooh.
We don't even need the bank statements.
Really?
There are different forms of income verification.
And what kind of challenges self-employed people get into?
People always say like, oh, you can't. Self-employed, it's really hard to get mortgage financing. It's not the case.
Let's play a game that is related to money. 500 every month for 10 years.
You could have saved $172,000.
Wow.
One of the things that I wish I would have done in my 20s, and I always remind myself that if it's supposed to be easy, everybody would do it and everybody would be amazing at it. This is how people fall into this trap. They take their word for it, they go buy a house.
25,000 saving with 680 credit score.
You can buy a house for $500,000.
Welcome to Average Immigrant Millionaire podcast. Namaskar, my name is Aditya Soma, and today is the first podcast we are shooting. And the reason we named Average Immigrant Millionaire is, I am an immigrant to Canada. I came to Canada 12 years ago, and I was always the average guy. I was the average student in the class, average student, average marks in my IELTS everywhere. I was just an average guy. But I learned a few years ago some powerful lessons, powerful mindset related to money that made me millionaire. And I believe, if you, whoever watching this, podcast, if you believe that you're an average guy, but you want that freedom, I am here to tell you that. And with the stories, there will be a lot more stories coming up like me and, probably like you who are just average, but with the right mindset, with the right tools, right knowledge, they became millionaires. So this podcast aim is to make you millionaire through different kind of stories. So with that, today we have a special guest who is my very good friend for years and also an expert in mortgage industry. So we're going to crack mortgages in Canada in 2025 with my good friend CIBC Mortgage Advisor Pritish Raval. Brother, thank you so much for being here.
Of course, man. My pleasure. Thanks for having me. Super proud to be part of the first podcast.
For anyone who is watching this, who are you? If you can tell it in few seconds.
I'm James Bond. No. So as you introduced me, I'm a mortgage advisor. And so what I do is I help families buy homes, refinance home, restructure their debt, and make sure that they're able to achieve their home ownership goals or other goals they have. So we do, home financing.
And as I know your story, you quit your job when you had your third baby on the way. What was running in your head? What made you make that move?
Yeah. So this is during COVID. So like COVID had just made its way to Canada. Prior to that happening, I had a great career, and I still do with my bank. And I was working in an upper management position within town in retail banking. And I always believe that if you're confident in your abilities and you're always a student of learning, right? You're learning how to become better at your art, at your craft. And if you feel like you're ready, you should bet on yourself and don't rely on anybody else. You should bet on yourself if you're confident in your abilities. I was at a point in my life, I had 2 kids. I felt confident. I felt that if I chose to do something and put my full mind behind it, full focus behind it, I could be more successful than I was even as in the leadership position.
So you were a leader,
yeah,
and then you turned into a mortgage advisor.
That's right. Yeah. So usually people don't go that way. They usually, once they're in leadership, they'll pursue the career in leadership. But most of my career was in management and in leadership, and I loved helping individuals achieve their goals of moving up in their career and doing things. But at that point in my life, I needed to answer some questions about myself. Am I able to achieve what I think I can achieve? Am I disciplined enough to push myself into areas that I have not done so before.
Hmm.
I was comfortable in the
Yeah.
leadership position. I'd been doing it for years. And so you have a moment in time where you need to challenge yourself.
Hmm.
Maybe you need to push yourself. And this was going to get me out of my comfort zone. I had a somewhat of a network in the real estate side of business, but
Yeah.
not that big of a network.
Mm-hmm.
And the position is 100% commission.
Hmm.
I've never worked only
On commission.
commission. I've always had, salary, right? Salary bonus, salary something. So 2 kids, 3rd child on the way. I had already given my notice because I was like, I think I can do this. My wife is like, let's do this. So I actually gave my notice,
Hmm.
that I'm going to change positions, resign from my previous position. And then we found out we were pregnant.
Ooh.
So I had already given the notice, and then we found out we were pregnant. And so we're like, what do we do? I can't really go back and say, give me my job back, So at that point I was committed. I couldn't go back and say, hey, I have a baby on the way. Can you please give me my job back? I don't think it would have worked out that well. So I had to go with it. And I always reminded myself, you have to stay disciplined, self-regulated.
Hmm.
And I have to answer a lot of questions about me as a person, as a man, everything that I've learned up to that point.
Well, lovely, man. Let's talk about something that, everyone needs to know first. What is the one thing most people get wrong about mortgages in Canada?
The one thing that people get wrong the most is they don't educate themselves enough before making a decision whether they can buy a house or not.
But what kind of education are you talking about? Because, for those who are listening,
Yeah,
because I know I read mortgage
for
related
sure,
books also.
for sure.
But let's say, I'm a first time home buyer.
Yeah.
What kind of knowledge do you think I should have?
If you're a first time home buyer, I think you need to talk to like a good qualified lender, right? And you need to understand, what is CMHC, right? A lot of people get surprised. That's a mistake a lot of buyers make. They don't actually know what the CMHC premium is going to be. And then when we do the mortgage, or if your mortgage is done and you have no idea, right? Oh, you're going to pay $17,000 more to roll into the mortgage as default insurance. So there's things like the lack of education around default insurance, down payment, income, mortgage rules and restrictions. They don't really understand too much.
Yeah.
So what ends up happening is people will, without understanding, they'll go and purchase a home and then they'll try to qualify after.
Yeah.
That's the biggest mistake. Get qualified first.
Yeah.
If you go buy a house and then you try to qualify, it's a lot more pressure and you may make the wrong decision in that situation.
Let's say I am coming to you as a client.
Yeah.
And what are the steps you would recommend or you would do for me, like in simple steps?
Yeah. So I think the first thing we need to do is we have to figure out what you're going to be approved for. That's the main goal whenever somebody comes. So if somebody comes in or gives me a call and they're like, hey, I'm a first time buyer. I don't know what to do, where to start. So we break it down for them.
Okay.
There are 3 things that we look at whenever we're qualifying a client, right? We're looking at income, down payment, and credit. Okay. And so what we want to do is we want to understand a little bit about each category for the client, right? So what's your background? Where do you work? How long have you been working there? Right? What about your credit? Do you have any other liabilities, car payments, student loans, lines of credits? How much down payment do you have saved? We want to put all that data together to determine what you'll qualify for. But we'll put a roadmap for the client, right? From beginning to end. First is data collection, qualifying, you have your approval, then there's house shopping.
Gotcha. So once they find the property, then, it's like pretty easy from there.
They're already approved ahead of time.
But there is a, lot of confusion in this terms, pre-approval versus approval, because I have, heard, or I even personally, I came across stories, right? Like, where client said he's pre-approved, but his mortgage got denied.
Oh yeah.
What was happening in those situations?
Yeah, that's a good question. So there's a few different things to keep in mind. There's pre-approval, there's your final approval, okay? And then you have pre-qualification, some people use as well, right? So to answer your question, what could have happened? Client said they went to their agent, mortgage agent, they said they were pre-approved, but then when they bought the house, they got denied.
Yes.
So what could have happened is that the mortgage agent might not have actually pre-approved them. Okay. They might have not actually pre-approved them. That's one thing.
So if they were pre-approved, that means they would have got the mortgage.
Not necessarily.
Not necessarily. Okay.
Yeah. The reason being is now, let's say I pre-approved you. So I pre-approved you today. It's based on your income of X. Okay. And you have no other debts.
Okay.
Perfect. You're pre-approved. You go start house shopping. You buy a house. But during that time period, you also went and bought a car. Okay. Now, when I did your pre-approval, you didn't have a car. You had no car payment.
Gotcha.
But now, between your pre-approval and you actually buying the house, you went and bought a car. So now you've added a liability that was not there anymore. So the pre-approval is technically not valid now because you've added more debt.
Sense.
So that's another reason why that somebody could get declined after the fact. And so the education piece
is like, what are all the things you can avoid?
Correct. So that's what we do. We want to make sure when we're pre-approving a client, we tell them, when we send them the pre-approval letter, we tell them in the email, please make sure there's no change in your financial situation. Please make sure that there's no change in employment information. Because even if clients will say, oh, I got a better job,
but
with more money, but now I'm on probation.
And probation can make them
make the pre-approval null and void.
Or, they're expecting a baby. And now wife going on maternity leave.
It could all factor. The good thing is about people going on parental leave is we can still use the full employment income, even if when you're on parental leave. So that's usually not the case. But the case, what I find a lot of times is people will change jobs or they'll add debt. So the change in their financial situation can obviously impact the pre-approval.
So it's always, once you start the process, just stay in touch with your mortgage agent for even a little change in your financial situation. So that you don't get denied.
Correct. Yeah. A lot of times people think, oh, I only did this or I only did that. But if your numbers are very close to not getting approved, even taking $5,000 out on a credit card or $5,000 on a line of credit could decline the deal, right? So it's important.
They might think it's not a biggie, but it's now added to
I just booked a trip for $5,000. I'll pay it off, right? But all of a sudden, that $5,000 can get them declined.
Yep. And so, for my mortgage purpose, I'm a salaried buyer. I'm working on a full-time job. What kind of documents, a list of documents that you would need, and how would you structure them so that, my mortgage advisor will easily approve me?
Yeah. So anybody who's salaried, right? So generally, obviously the longer you're with your employer, the better it is, right? Obviously you've been with your employer for 1 year, 2 years, 3 years. The longer, the better.
What's the minimum?
Less risk. There is no necessarily minimum. Okay. We get files approved even if you've been with your employer for 4 months.
Gotcha.
Okay. Because there are situations where you have experience in the industry, right? So for example, someone who's a software engineer, okay? They've been a software engineer at company A for 2 years, right? Now they change companies and they're with company B for only 5 months.
Gotcha.
That's okay. They're in the same field of work. We can use the 5 months of
and
income.
As long as they're not on probation.
Correct. Probation is usually a lot of times, a lot of lenders will ask for clarification on that. Because during that probation, you could be let go without cause. So that's a point of contention. But generally for anybody who's salaried, the documents we would be requesting are pay stubs, T4s, right? Maybe a letter of employment because you don't have a T4 because you've been less than a year.
Yeah.
Right. So a letter of employment is pretty common. Bank statements to show, payroll deposits.
Yep.
Stuff that you should be easily able to access if you're working, right? So pay stubs, T4, job letter, bank statements where your payroll goes in. These are all easy documents to
But what are some of the, challenges you see when it comes to collecting these documents from people who are, employed?
Yeah. So usually what I find is like when people are going on vacation, so they provide me a pay stub, but the pay stub is not showing full-time hours because they took some time off, right? So now we're saying to underwriter that, hey, they're working 40 hours a week, but I have pay stub only showing 27 hours or 21 hours. So stuff like that. A lot of times we'll run into challenges when we're looking for a letter of employment. A lot of companies, the letter is like a very generic letter, right? Letter just says this person works here, this is their salary. If it's a newer employer, so you started working there more recently, we may require a little bit more detail, which is hard to get on a letter because if it's a generic system generated letter, you may not get that. But to be honest, for the most part, with salaried clients, it's usually pretty straightforward, right?
Yeah, if they have all the documents.
Yeah, exactly. Yeah. So if you've been working at a company, like I said, none of the documents here are hard to get. Pay stubs
Gotcha.
are easy to get.
Yeah.
Job letter should be easy to get. Usually we don't even need a job letter, but if it's less than a year, we might need it. T4 is easy to get. You have your, bank statements. We don't need all of these
So
things.
why do you need bank statements?
We don't need all of them.
Okay, how many months bank statement you would need?
We don't even need the bank statements.
Really?
Yeah, we don't even need the bank statements. Yeah, the bank statement. So there are different forms of income verification. Okay. So some lenders can use pay stub. Some lenders can use bank statements. Some lenders can use, T4s.
But how
some
would you
lenders can use.
prove the proof of down payment?
So bank statements is only for the down payment portion. I'm saying for payroll, we don't necessarily need bank statements.
So that means you still need a bank statements.
Correct, but not for
the income,
for down payment.
But for down payment.
That's where we can run into some challenges.
So what kind of challenges in the down payment side? Because this is one thing I noticed a lot of challenges.
Yeah. So this is always down payments, it's important. Without 5% down payment, there is no deal. There's no purchase happening. So you have 5% is the minimum for down payment. And we also need 1.5% in Ontario for closing cost.
So
that we
all
have to
that
show.
money has to be in the account.
It doesn't have to be in the account. So I'll go over that.
Okay.
So remember, the numbers are minimum numbers, 5% for down payment, 1.5% for closing costs. 1.5% of the purchase price. So we have to show when we're getting a file approved, we have to show that we're going to have that much money total
in the account,
or we're going to have that money before closing. That's what we have to prove. Okay.
So if I don't have in my account.
Yeah. So you can get a gift from a family, right? An immediate family member. That's very, very common right now.
Yeah.
You can imagine, people buying houses for $500,000, $600,000, $700,000.
Can Pritish be my brother and funding me the money?
I don't have that kind of money. I have one brother. But if you have a brother, if you have a brother, yes.
So I call Pritish as my brother every day.
Your immediate family member.
Okay.
So mom, dad, brother, sister, and grandparents.
Gotcha.
Okay, immediate family member. So you wanna make sure you have an immediate family member that allows you to get a gift letter from them. Okay, gift is common. Usually we can use gift. You have your investments, obviously RRSPs, FHSA, personal accounts, money overseas. We can use a combination of everything.
So that's for the if they're buying a primary home, right?
Correct.
If they're buying the home for their purpose.
Yes.
But what if an investor, now I got my primary home. Now I'm buying for, investment purpose.
Yeah.
So now in that case, any other additional documents that the lender would need?
So you're buying an investment property.
Yeah. I already have a primary home.
Yeah. So you want to buy
an investment property.
So for investment property, we don't need any additional documents. You just need 20% down payment.
20% down payment. And is it required? Is it a must from every lender to have? Because this is one of the challenges I come across all the time. I should have at least money in my account for 3 months.
Correct. So for down payment, if it's your own sources, right, you have to show 90 days, right? So anytime we're looking for down payment information, we're looking for 90 days bank statements.
What if I don't have?
So we have to source the money.
Okay. So
we have to figure out where did the money come from.
Can the investment down payment also shown as a gifted funds?
No. So if you're buying a rental property, if you're buying a rental property, the 20% down payment has to be from your own sources.
So your own sources means, let's say I have a corporation, money comes from that.
Correct.
And here cannot come from Pritish also, because even my brother cannot help.
You and your brother cannot help. Exactly.
So what are the other sources that I can get my down payment? Yeah.
So pretty much you can use, if you needed to leverage some money, like if you're using, let's say, a line of credit or something, you can try to do that as well.
Secure or unsecured?
You can use, if you're going to use unsecured, you can use secured for sure.
Okay.
Right? If you use unsecured, we have to disclose it. Okay.
Gotcha.
To underwriting. If you're using secured, we have to disclose it as well. Secured payment, if it's a secured line of credit, the payment calculation is lower. So that's preferred for ratios.
Gotcha.
If it's unsecured, the payment's higher. So it may impact your ratios negatively, right?
So it might impact on your approval amount.
Total amount, yeah.
But if I'm buying an investment that has rental income, it can help.
Yeah, it can offset. It can help offset it. Yeah.
So line of credit, a secure or unsecure, what else can be the source?
Your corporate account is fine. So business account is fine. Business account.
But then you have to be the director.
Correct. You have to be the owner. Yep.
What else?
And then that's pretty much it. Any co-applicants, same thing. Their accounts. It has to be your own sources.
Or if I have a RRSP,
you can use your RRSPs if you want. Yeah, no problem. It's your own money.
Pay the tax.
Correct. It's your own money. So if you're taking money out of RRSPs for not as a first-time home buyer,
Mhm.
you're going to pay tax on the income.
So let's switch the gear a little bit to self-employed.
Sure.
So what kind of documents we need, for self-employed,
Yeah.
and what kind of challenges
Mhm.
that self-employed people get into?
So for self-employed, like there are good options available for self-employed
Mhm.
clients. So that one of the myths is people always say like, oh, you can't self-employed. It's really hard to get mortgage financing. It's not the case. That is the case if you're not paying yourself much income. You're going to run into that issue for a long time. So for self-employed clients, what we're looking for is a 2-year average.
2-year average of their business income or their personal
income. So
Okay.
there's two types of self-employed.
Mhm.
Generally, you have there's more than two, but you have your sole proprietors. Okay.
Which means all the income is coming into your name.
Pretty much, yeah. It's in your
Okay.
name. You're not a corporation. You
Mhm.
are the business, right?
Mhm.
And then there's the self-employed incorporated or
Mhm.
corporations, right? Where the income is coming in a business name, and then you're paying yourself from the business.
Mhm.
So let's talk about the first one,
Yep.
which is, you're just a sole proprietor. Let's say I have a handyman business, right? I'm the handy guy. I'm doing work on the side and I'm paying myself. I'm collecting the money and that's the income I'm claiming. So sole proprietor, we're looking at a 2-year personal income average. Okay. And we're looking at personal income average for both scenarios, but for sole proprietor, that's all there is.
So you're going
There
to
is
look
no
at
other.
the 2 years bank statements or T1
T1 generals and notice of assessment. So there are different lenders out there
Okay.
that will look at bank statements.
Gotcha.
Right. You will have a hard time with bank lenders that will look at bank statements because we're federally governed. The banks are federally governed. Therefore, what you claim to the federal government in your income taxes
That's what they're going
is
to
the income that we're going to use, right? Which makes sense. But there are lenders out there that you can potentially work with, right? That can use other sources, other documents.
In simple terms,
Yeah.
I'm a self-employed, but I did not pay myself that much salary.
Yep.
So the A lenders usually will look at my T1 and notice of
NOAs,
assessment.
notice of
Based on
assessment.
that only they will qualify me.
Correct. Yeah.
But the B lenders, the other lenders, alternative lenders, they would look at how much income I'm getting into my account.
They may, yeah.
They may.
Yeah.
If
Correct.
there is enough down payment.
Yeah.
So that means there is still other options.
Yes. Yeah. There are always options. The options open up when you do 20% down payment.
Gotcha. So when you have 20%.
Yeah.
But if you're trying to buy on 5%.
I think your options are limited because now you have to work with the default insurer. You have to work with CMHC, Sage, and Canada Guarantee.
So just in very simple terms, what is the difference between 20% and 5%?
So on a $500,000 purchase, for example, 5% is $25,000 down payment. 20% is $100,000 down payment. Yeah.
And like you mentioned, the lender, here you only have a bank.
Correct.
But in the 5% case, there is a bank.
And there's the default insurance company, CMHC, that's also involved, right?
Is it just the CMHC or there are other companies?
There are 3 companies in Canada. The total
who pays for that CMHC?
The client.
So technically, you're not only just paying your mortgage amount, but you're paying some additional insurance.
Correct. Default insurance. Yeah.
So this is one of the common question I get.
Yeah. I can explain.
Should I go
Yes.
for 5% down or 20% down, save my premium?
So that's a good question. You have to look at the numbers. Okay. So generally, if you have 20% down payment, then you're going to save paying the premium.
Yeah.
Depends what your plans are with your capital, right? So if you've been saving the money for 20% down payment, then put the 20% down payment.
Yeah.
But if you've been saving the money for other reasons and you have other goals for that money, right? Because once you invest it in your property, you can't take it out, right? So it depends on your goals, right? Sometimes it's better to keep the money and pay the premium because you have other plans with your money. You might want to renovate. You might want to add an ADU. You might want to do other things.
Or you want to put it in the stocks.
Whatever. You might want to invest it. Yeah, you might just want to invest it. You're an investor as well. So I think it depends on your goal.
Yeah.
The default insurance, anybody who puts less than 20% down has to have mortgage default insurance.
Gotcha.
And I don't know if you want me to explain it.
Just in the simple terms.
Yeah. Default insurance, pretty much, there's 3 companies in Canada that do it. CMHC, Sage, and Canada Guarantee. And what it does, it protects the lender. So the bank or whatever lender it is, in the event if the client defaults or can't afford the mortgage payment anymore,
so the
lender gets paid off. But premium is paid by the client, which is added to
It's
the
like
mortgage.
pretty much how you're taking an insurance for yourself.
Correct.
You're taking an insurance for the mortgage.
Yeah.
And there is a premium for it.
Same thing.
So switching gear a little bit more to newcomers.
Yeah.
Because, there are different options for newcomers. What kind of documents this newcomers need? What kind of proofs these guys need to show?
Yeah. So there are different programs for newcomers. Obviously, right now we have the foreign buyer ban that's still intact. Which means that anybody who's non-resident, non-citizen, non-PR cannot buy a property without paying a foreign buyer tax.
And thank you for answering that. If you're an Indian watching this, Aditya, I want to buy a property in Canada. Unfortunately, you cannot buy residential property.
Correct.
But you can still buy commercial.
Well, you would know better about that than I would. Yeah.
So, but that's the ban you're talking about, right?
Yeah. It's on residential.
In a residential
It's on the
area.
residential, yes.
Residential is single family home up to 4 units or 6 units?
4 units.
4 units.
Yeah.
Maybe, don't quote us on that one.
It
4
could
or
be,
6.
Yeah,
it could be up to,
different. Yeah.
I believe 5 or 6.
Yeah. Like me personally, we do financing up to 4 units. Yeah. 4 units for us. Yeah.
Okay. So what does this newcomers?
So pretty much if you're looking to purchase a property, you want to have your PR, right? So you need your COPR. We need you to either have a PR or be married to someone who has a PR or is a Canadian citizen.
How about OINP? I have a nominee program.
Yeah, we have to provide confirmation of that as well. So we can work with that. We have to disclose all these things when we're going with the insured deal. So they're aware. But yeah, we can work with that as well. Nominee as well.
And for newcomer, usually they don't have credit history.
Yeah. So yeah, I run into this all the time. So it's a great topic, actually. Good. The question is, do you think it's better to have one credit card, so limited credit, one credit card where you never miss the payment, you never really use the credit card because you pay everything in cash? Or is it better to have, multiple credit cards, deeper history, but maybe you missed a few payments? What do you think is better?
The first one.
So you think the first one's better?
Yeah.
Right? Because it's one credit card, barely
never
used.
missed any payments.
Yeah, never missed any payments. Well, this person missed some payments, but they have more credit products.
Yeah.
Believe it or not, it's actually this person's better in terms of putting an application together.
Oh.
So I'll tell you why. So let's say scenario B, this person's credit score is 685. Okay. But they've been utilizing credit for 7 years.
Okay.
They've had a few missed payments, maybe a few other late payments. This person is, like you were saying, newer to Canada, has had one credit card for 1 year, but they barely use it. Now, when we're applying for a mortgage, right, we want to be able to describe that this person knows how to utilize credit. Although this person has not missed any payments, they haven't really shown
that they
know how to use credit. And now they're applying for a $500,000 mortgage, right?
Wow.
So they don't. So you want to utilize credit properly, right? You want to utilize it responsibly.
Yeah.
It's a tool that you can use as leverage to qualify for bigger credit items. But if you stay away from it, and then you're like, hey, I want to borrow a lot of money, but I never have used it or learned how to utilize it.
You know what comes to my mind? I'm a Dave Ramsey's fan. I'm not going to use any credit.
Yeah, man. It's all about what you believe, right? So I always tell people, like, listen, apply for credit cards, start getting some credit cards, but use it responsibly.
Yeah.
So that we have a little bit more depth.
Yeah.
Now, what do you do if you don't have the depth? What do you do? I just don't have it.
Yeah.
I've been here for a year. Here's my situation.
Yeah.
So we can use alternate forms of credit history. So let's say you've been renting.
Okay.
So what we can do is we can collect your rent receipt or that you've been paying rent out of your bank account for the last 12 months.
That can be
that can be added. Now you have a gym membership. Perfect. We can show you paying your gym membership.
Gotcha.
You're paying your cell phone bill. You have a car. You bought the car cash because you don't want to get a loan. No problem. You have insurance. Of course you have insurance. You're paying insurance. So we use it with those clients. We use those alternate forms of credit to show that, hey, there is merit here on repayment. The client can take on additional responsibility and manage to pay the mortgage and everything on time.
One thing that reminds me would be a very beneficial for newcomers. See, if you have some heavy debt back home and you have a full-time job, you can even get line of credits here.
Yeah.
You can just use some of it to pay off higher interest
Yeah.
amounts
Yep.
and pay it responsibly here.
100%. 100%.
So that brings me up to another alternative question
Yeah.
here. For example, I have a $10,000 credit card.
Yeah.
How much should I use the utilization, total amount, to keep my credit score good?
So yeah, what you want to do is you always want to try to maintain the balance. You want to try to keep it 70% or below.
70%.
So
So that
7,000 in
means
this case.
I should not use more than 7,000.
You can.
You
That's
can.
okay. You can. That's okay. But if you stay, let's say you have a $10,000 line of credit or a credit card. Credit card's better example. $10,000 credit card and you've used 9,500.
Yeah.
You use 95% of it. But if you remain in that high credit utilization for months and months and months,
Then your credit.
then it will negatively impact your credit
Gotcha.
because now you're high credit utilization and you're
Even
not
for
paying it
secure
down.
line of credits?
No, same thing. It's like it's on secured facilities is different, but you don't want to have it maxed and stay at the max for too
For
long.
months.
For months because then you're relying very heavily on credit.
On the credit.
On the credit.
So
if there was
safer zone is to keep under 70%.
yeah, if you keep under 70%, it's okay because you still have 30%.
Yeah.
And you're not hitting, even if you're at 70% for months,
Yeah. Still,
you're
that
not
is not good.
hitting your credit negatively because you're not maxed out on everything.
So you're not using maximum. So
Max,
it's better
yeah.
to stay under 70.
70%. Yeah. Especially if you can't repay it right away.
Yeah, especially
want-
like, home equity line of
Correct,
credits,
yeah,
right?
yeah.
Like, the ones that are tied up to the house.
Correct. Yeah. When you max it out and it stays there, and when you go to reapply,
Yep.
it can also impact your ratios and stuff, right? Higher
Okay, so
payment.
we're going to play some fun game.
Yeah.
But before that, one last question, a complicated one,
Okay.
which we hear all the time in the
Yes.
mortgage industry. GDS, TDS, what does it mean? And explain me in a very simple terms as if like I'm a 10th grader.
Okay. So GDS, TDS. Okay. It's simple enough. I can explain it. So it's two ratios. Okay. There are two ratios that we look at. GDS stands for gross debt servicing ratio. So let's just talk about that.
Yeah.
GDS is just your house debt. Okay.
Debt.
Yeah. Your house debt. So when you're applying for a mortgage, especially if you're putting down less than 20% down payment, we want to make sure so let's say your monthly income is $10,000 a month. Your housing expenses, which is your mortgage payment,
Yep.
your property taxes, and your heating estimate, those three expenses do not exceed more than 39% of your monthly income.
So which is 3,900.
900, exactly. Yep.
Gotcha.
So if you have a $10,000 a month income, your housing expense cannot be greater than 39% of your income.
But we hear all these stories, people do mortgage frauds in this area, right? Like, so what kind of things that you would recommend people avoid? Because especially there is a, big mark in these bigger cities, especially they use, wrong income documents or what is your take on that?
So my take is always you should buy a house that you can qualify for the right way. Reason being is you can get your mortgage approval canceled even the day of closing.
Can they cancel after closing?
Yeah, they can ask you to get requalified at another bank, right? Or another lender. And they can give you a window. They can say, hey, you've got X amount of time to transfer your mortgage out of whichever bank you're with to somewhere else. Yeah. And then so now you have to go, right? Plus, remember, if you're committing fraud, you're exposing yourself to a fine. Like there are legal consequences.
What's the craziest story you ever heard in this area?
Well, I think I heard about client getting caught up in it and a lender getting caught up in it. And I think the lender was fined like $50,000. The mortgage lender was fined $50,000. And there are financial consequences to the client as well.
And I heard like they cannot get mortgages because of that for certain years.
Of course. Yeah. Like it's not a good thing. Like you're committing a fraud, right? Yeah. So like you don't want to do that, right?
Yeah.
I don't know why people do it. I think people maybe are desperate. Like maybe like I said, they went and bought something and then they're trying to figure out financing after. I don't recommend it. It's peace of mind is do it the right way.
Yeah.
Get approved first, buy within. And if you know what, if you don't like anything because your budget is, let's say you feel like your budget is not big enough, there are ways to get a bigger budget. Get a co-borrower.
Yeah.
Right? Maybe put a game plan together on how you can earn more income. Come back to us in a year, right?
Yeah.
Maybe put a game plan. So that's the strategy we always want to apply. Like if you can't do it now, it doesn't mean it's a no forever.
Yeah.
let's put a plan together. Come back. I've had clients where we put plans together and they've come back 2 years or 3 years later.
Yeah.
And they've bought their first house.
Because that's more peaceful for them, right? Like, that's more,
100%.
they can plan their finances better.
That's what I mean. You put a plan together, and if you stick with the plan, because really, for the most part, a small increase in down payment will change the ratios quite a bit.
Gotcha.
Or your job, you may get a promotion, right?
Yep.
I know. I think we went off track. You asked me what GDS was.
That's fantastic. So so finish off the GDS, TDS.
So we did the GDS. So I'm gonna reset here. We did GDS. That's 39% of the income. The key to know here is the mortgage expense that we're talking about, the monthly payment. That is the stress test payment. Okay. So just keep that in mind. We'll come back to that after.
Yeah.
The TDSR is total debt servicing ratio. Okay. So what it is, it's your housing expenses plus all your other debts that you may have. So car loan, line of credit, credit card.
Gotcha.
Not insurances or anything, but just debt. Okay. And that number cannot go over 44% of your monthly income.
So that means, let's say I have a car payment of $400.
Yeah.
And my house coming around $3,000.
Yeah.
So now it's $3,400 and I have a credit card.
Yeah.
I owe, like, the monthly payments I have to pay is like another $1,000, let's say. So now I'm at $4,400. So now I'm at 44%.
Exactly.
Gotcha.
So total debt ratio cannot exceed 44%. But remember, part of the housing expenses were the property taxes and heating estimate as well, right? So,
and for the debts, like, let's say I have a student loan.
Yeah.
Do they calculate the total amount, or is it the monthly payment I have to pay for them?
So this is a really good question. So a lot of times clients will come to us and say, oh, like, I'm in partial repayment, right? I have a $40,000 student loan, but I'm in partial repayment. I'm only paying $125 a month.
Yep.
Okay. We can ask for an exception to use just the 125.
Yep.
But not always does that exception get approved. We would actually have to calculate the full payment because the partial repayment is going to end at some point, and you'll have to do the full repayment. Exactly. And so when we're doing underwriting or when we're submitting the file, a lot of times we can't get that exception to get the file approved with the lower payment, because that's a valid point. Hey, this payment is only for so long. It's not forever. The forever payment is actually $450 a month.
Gotcha.
Right. So if you have a student loan, just keep that in mind. It's an exception we can ask for, but it's not guaranteed.
So let's play a game that is related to money.
Okay.
I'm a self-employed or employed. I am making $10,000.
Yeah.
And I have 3 envelopes here for you. How would you advise the client to allocate that $10,000 money if they're planning to buy a home in next 1 year or 2 years or next 6 months? So pick one.
Okay. This one is savings and investments.
Yeah.
All right. So how much money would I allocate to this?
Yeah. So me and my wife together making $10,000.
Okay. So I would say, as a good rule of thumb is probably 20%.
20%.
$2,000.
And pick another one.
All right, let's take a look. Okay. Fixed expenses.
So if you can explain a little bit on what's fixed expenses and how much would that be?
Yeah. So I think fixed expenses are, your rent.
Yeah.
Monthly expenses that you have. Rent, mortgages.
It's like must.
Yeah, you must. You have rent, your mortgage payment, maybe your car payment, right? Your insurance.
Yeah.
So I think you have to allocate, generally, I would say, 65 to 70%. So $6,500 to $7,000 for that.
Wow. So you put 2,000 in this one, and you have 6,000 to 7,000.
Yeah.
So you only have 1,000 left.
That's it.
Pick the third one.
I think the 1,000 should be, perfect. Should be like discretionary spending.
What if I have 5 babies? You have 3 babies, bro. Can you handle that in $1,000?
I think that goes into your fixed expenses, right?
Oh, gotcha.
You have to, you have your soccer, you have your piano, you have, your
classes. Okay.
That's so fixed expenses.
Okay,
you have daycare. It's fixed expense. Discretionary is like, hey, I'm going for coffee with my friends.
Okay.
I'm going for dinner with my friends. I want to buy a new shirt. I want to buy a new suit. Your discretionary spending has to be
buy a custom suit like that.
Very, very minimal. Yes. Yeah. So this is discretionary spending. You want to have, it should be about 10%.
10%.
70, 20, 10 rule. That's a
I love that
old finance rule that people used to use. I stick by it.
And if someone wants to achieve your financial goals faster, then increase that. I started with making 50% on my investments first.
Yeah.
And then my fixed expenses were less than 30%.
So let's here's a good example, right? Like we were talking about this earlier.
Yeah.
Right. One of the things that I wish I would have done in my 20s.
I know you're going to share that story.
Right?
Yes.
Is I wish that I see this mistake.
Yeah.
This mistake.
Me too. I can relate to that.
People
a lot.
in their 20s.
Yes.
Early 20s. I spent a lot of money. Most of my money went on discretion. Not much went into savings. Even though I had fixed expenses, most of it went on discretion. I went out, I spent my money with my friends a lot. But on average, like in your 20s, even if let's say you have a part-time job in your early 20s, you're probably making, you can probably making $1,000 to $2,000 a month minimum after taxes, right? So you can save, let's say if you focused on saving $500 a month, which I didn't. But let's talk about it. I think if somebody starts saving $500 a month, right? I'm just checking a calculator. From let's just say 20 to 30.
Okay.
20 to 30.
20 to 30, 10 years.
Yeah, 10 years. Mm-hmm. So you're saving, you have $0 to start, but you start saving $500 a month, okay?
And at this point, you're not even married, you don't even have kids. So that means your expenses are
you're probably living at home.
Living with your parents for free.
$500 a month, I think, is reasonable.
Yeah.
Maybe you could do more if you're really diligent. Okay.
So let's take three examples.
We'll do
One is 500.
Yeah. So you start at 20 and you're trying to go for age 30. That's your goal. And again, remember, between 20 and 30, you're going to get a job, bigger job, better job, more promotion. I had, like I said, I've been in the bank over, 15 years. So I had a lot of opportunity to save.
Yeah.
But if you did that for 10 years, okay, take a guess. So if you put $500 a month aside in 10 years,
in a mutual fund,
mutual fund investment, I'm using a 7% as a rate of return.
Very minimal, which is very doable nowadays. With
7% as a rate of return. If you did 500, I'll just give you the number instead
500 every month for 10 years. How much is the number that I'm going to have?
Yeah, $86,000.
Wow. So just 500.
That's it.
So that means yearly you're putting $6,000.
Yeah. So you're putting $60,000
and your
investment is $26,000.
What if I bump it up to $2,000?
Well, that's a big jump.
Yeah, because what do I have, man, at that age?
I know, but you know what? Like, look, I got married in my 20s.
Yeah.
I had kids in my 20s. So your thing might change. But let's say average. Yeah. Maybe you're averaging $800 a month.
800 or 1,000. Let's put round figure.
Okay, let's put
I'm always positive. I want to look at the bigger picture.
Okay, if you did 1,000 a month.
Yeah.
So if and then let's say, whoever you're with, right? You were like, hey, let's start.
And each 1,000.
Or let's say you did 1,000 combined.
Yeah.
For 10 years, at 7%, you would have $172,000.
Wow.
So from 20 to 30, you could have saved $172,000. And at 30, you'd be very well equipped to do whatever you wanted.
And that can change completely. We are talking about 7%, right? What if you're getting 10%? Because nowadays, any S&P 500 itself is also like average 10 to 12%, right?
Much higher.
Yeah. So, the rate of returns can change and the compounding is adding to it.
Yeah.
See, this is the power, I think, I always I regret for not starting in the earliest.
Yeah.
I was sharing a story with you before, right?
Yeah.
Like a 21-year-old guy I'm helping right now to do a brand new bird project. This guy, 21-year-old, he comes to me with 200,000 savings.
Wow.
I was asking all the questions. Is this really your money? Because I was trying to find he got his from his parents.
Right.
But it was every penny was his money.
Good for him.
What did he do? He started when he's 14 or 15. He was doing some renovations. He started with Paintworks. And he said, this guy is like an immigrant kid, right? He's a second generation here.
Yeah.
But he had that immigrant mindset, saved every penny. Now, by the time he's 21, he had 200,000 and he met the right people. Now we are doing his brand new bird project, which means in less than 7 months, he's going to take whatever he invested in the project. He invested 200,000. And end of 7 months, he's going to have his 200,000 back. Plus this project will make $1,500 cash flow
per month
after all the expenses. And it's a brand new.
Yeah.
Now let's fast forward because I can do 2 or 3 projects with him like that. So let's imagine he bought 3 or 4 projects like that with this only 200,000.
Yeah.
because he's moving from one project to another project.
Yeah.
Now he has 7 to 8,000 cash flow by end of like 2 years from now.
Yeah.
But let's fast forward. He's still 23. By the time he's 30, how much equity he's going to build in these 4 projects?
Oh, yeah. A lot.
Or let's say each 100,000
minimum.
Very, very conservatively, right? 100,000 that means 400,000. By the time he's 40, what are the chances his mortgage is almost paid off?
Pretty good, man. Especially if he's using that extra cash and putting it on the property itself.
And by the time he's 50, he got busy with his life. He didn't do any other investments. He hit 50, but all these mortgages paid off. And they're still 30 years old homes. And now the cool part is the cash flow from 1,500. Each property is producing $10,000 income.
Yeah, because it's paid off.
Yeah, into 4 now.
Yeah.
So he's making 40,000 every month plus $4 million, even if the prices stayed where they are.
Yeah, he could easily sell or do whatever he needs to if he had to. But you just take the money, the income that you're earning from it.
But see, for him, the cool part is because he started young.
Yeah.
And this is like an average guy.
Yeah.
Don't have any special expertise.
Yeah.
Not an AI, the Bitcoin millionaire, billionaire. This is like pure, consistent in making and saving.
Yeah.
And putting into right investments.
Yeah. It's interesting what you can do when you have the knowledge, what you can accomplish with it.
That's exactly why we are doing with this podcast.
Yeah. Once you know how to use your skills or save better and apply it, you can accomplish a lot more.
And now I'm going to go over some common questions I get from our clients.
Sounds good.
Should I not take a variable right now? And when does it make sense?
Yeah. So variable and fixed, I think it comes down to what your goal is with the property, right? I think timing the market is hard to do.
Yeah.
Just like the stock market. I think variable is good if you're looking for flexibility, right? So if you want to sell the property, if you want to maybe refinance the property, if you're thinking about renting it out, whatever your financial circumstances may change, go with variable. It gives you the most flexibility.
Why is that?
Because when you break a variable mortgage, you get the penalty is only 3 months interest.
So break in the sense if I have to sell the property.
Walk away completely.
Let's say the mortgage.
You bought it, something crazy happened. You have to now move to Saskatchewan for work. And you don't want to handle this property anymore. You just want to sell it and walk away. Then it's only 3 months interest as the penalty, right?
But for fixed,
it's different. And it's all different from lender to lender, right? But generally the variable property is variable product is usually the same penalty, usually across the board. Always talk to your lender, find out what the penalty is going to be. And then make an informed decision. And remember the rate, fixed or variable, it's only temporary. So don't get too fixated on the rate.
What do you mean by only temporary? Because this is something many immigrants doesn't understand. Myself, I didn't understand for years.
So like people come in right now, they do a 3-year fixed rate.
Yeah.
Okay. So let's say the 3-year fixed rate is 3.8%. Right now. And they are so focused on the rate because they're like, I want 3.7, I want 3.75, I want 3 right? But it's like, hey, it's only for 3 years.
Yeah.
Okay.
So how much difference would it be?
It's going to be like $15 a month, for example. Depends on the mortgage amount, $10 to $15 a month. So in 3 years, it's $500.
Yeah.
Okay.
Oh, that's it.
Cash flow wise, right?
Yeah.
Now, in terms of interest, you pay a little bit lower interest over that period of time, but not anything that's life changing. Okay. So it's not going to change your life.
Yeah.
Focus on the property. Property is the most important thing in the home buying process, not the rate. The rate you can change 2 years, 2.5 years later. You don't even have to wait the full 3 years. So it's very temporary, but the price you pay for the house is forever.
Yep.
The property you buy is much harder to sell. No one cares about your rate when you're selling the house, right? So I always tell focus on the house, focus on the price, focus on the location. Way more important than rate. So rate is temporary. It can be changed.
Get the best possible price at the best
deal. The deal is way more important than the rate.
Yeah.
The rate is like whatever, $10, not going to change for you.
If you could negotiate $5,000, what's the difference we're talking about?
It's nothing, man.
It's like almost you're getting 0.5% less.
Yeah, 0.005.
0.05,
yeah. That's nothing. It's nothing, yeah.
How would I pick the length of the term in simple terms?
Just based on, hey, are you going to hold on to this property forever?
Mm.
Right? Are you a risk averse person? So think of yourself as an individual. Do you want to pick the rate, have a payment you're comfortable with, and don't want to think about it?
Yeah.
If that's the type of person you are, then go with a longer term, right? Simple. I'm comfortable with this payment. I can afford this. This is within my budget.
Yep.
I don't want to think about it for the next 5 years of my life or
Gotcha.
the next 7 years of my life, because there's a 7-year and a 10-year term.
But usually, is it lower or higher?
It's usually a little bit higher. Depends on the market. So
Gotcha.
sometimes we have been in there have been times where the longer terms are shorter, right? Just depends. But or are you the type of person that, hey, you know what, you're staying on top of everything. You want the best rate possible. You don't want to tie in for 5 years because you may sell, you may move, you may relocate. Then go with a shorter term or a variable term.
So what I'm understanding is it all depends on you,
It's
who
all
you
on you.
are,
Yeah,
and what
yeah.
you want.
Correct.
Because this is one place where I see a lot of people get stuck with.
Yeah.
And what kind of penalties that most people put a blind eye to? Like, they don't really knew that is coming.
So when they're getting a mortgage, that's why you want to ask what I said. Always ask your lender what type of penalties are there if you break the mortgage, right? Because if you don't know the penalty, what it's going to be when you go to break it, because you may think it's 3 months interest, but it could be higher.
But
right?
I heard, this is one experience I had. Even some lenders don't even allow you to refinance if
Correct.
you're in your terms.
Yeah. So there are very strict policies with certain lenders. You cannot refinance. You cannot put a secured line of credit on your property. You cannot put any sort of second charge on your property. So that's very important, right?
With your permission, I'll explain this concept in a very simple terms, because I was confused when I was probably after bought 6-7 properties. Also, I didn't know this time. So if you're getting a mortgage and let's say yours is 5 years fixed, or let's say lender is some random lender. Sometimes even if you want to pay down all the mortgage, you have all the money, you would not be able to.
Correct. Yeah.
Because there is certain set
rules
you have to follow.
Yeah.
So you have to know what those rules are.
Yeah.
What those penalties,
These are
prepayment penalty.
Prepayment, what you can prepay.
Yeah.
And if you pay it off before the term is over, what the penalty would be. Yeah.
What would be the penalty? So that changes from lender to lender.
Correct.
So always check with the lender.
Yeah. Usually like it's 10%, 15% is what you can pay annually.
Porting. What does it mean?
Yeah. So porting is when you want to transfer your mortgage from one house to another. So you bought a house. Let's say you have a killer rate. Okay. You got, 1.9% or 1%. And now you're selling this house, but you don't want to lose your rate. You are like, man, I got a really good rate. I'm selling this house. So you can port your mortgage. You can transfer your mortgage from your current property to another property. Usually there are rules around like the timeline. You have to transfer the mortgage within, let's say like 120 days or, 150 days.
What's the CIBC's timeline?
So ours is 120 days, but we can get up to 150 days as well.
So in simple terms, I am owning this house.
Yep.
I bought the property like 5 years ago.
Yep.
And I have a fixed, or 3 years ago.
3 years ago. You have 2 more years left on the rate.
2 more years left on that term.
Yep.
And my rate is 1.5.
Correct.
And I have a mortgage of, let's say, 300,000.
Yes.
Now I'm buying $1 million property. I'm upgrading myself.
Yep.
So that means I can carry that rate.
For the $300,000.
Only 300,000.
Correct. Exactly.
Because that was the mortgage I have.
That's the mortgage.
So I am just I'm just getting that rate for that 300,000.
Only for the 300,000.
And only for 2 years left over that term.
Correct. Now, if you need to borrow more money, then you're going to be borrowing the new money at the current rates.
Gotcha.
Right? And then what we'll do is we'll blend the two rates.
Mortgage industry is like an ocean. I know there is a lot of red flags, right? So name top 3 killers that you see every week where mortgage is getting denied.
Yeah. So I would say the top 3 kill the deals. Things that kill the deals. So one is always car loan. Car loan's number 1. Mistake everybody makes when they get the first job that everybody gets, the first thing they buy is a car. I made that mistake. Yeah. I don't know if you made that mistake or not. The first thing I went and did is I bought a car. Yeah. I went and bought a nice car. That car payment kills the deal. Second thing is changing jobs or having a big change in your financial situation, right? So the deal is ready to go. everything's good, and then you change jobs. And like I said, you fall into probation.
Yeah.
Right. The third thing is a combination of things. So a lot of times I see like additional credit card debt come on board. So sometimes people will start buying things on that finance plans. That kills the deal. So like, oh, I'll go to Best Buy.
Yeah, I got a nice brand new fridge. For $5,000.
Correct. I put it on. There's no payment due for 3 years, 4 years. No, there's
debt.
That's debt now, and it's showing up as a repayment. So I see sometimes clients get excited.
Yeah.
And what they'll do is before the house closes, they've gone and, purchased all the furniture and everything, and they put it on payment plans, and then
buying the furniture before even closing the house.
Before closing the house.
And that's on the loan.
Correct. And like, let's say if there's a material change on your application, there could be a reason to do a new credit check. So those are I would say top 2, 3, like, job change, financial situation change. Car loan is number 1.
Why do you think that would impact?
So ratios. So first thing is car loan kills the ratios.
Yeah.
Payment kills the ratios. Income change or increasing in any sort of debt.
Yeah.
Or lower income can change your ratios. And then obviously if you take on credit card debt or payday loans or something that allows different payments.
So basically any money you're trying to borrow.
Correct. Yeah.
Anything
you borrow.
You gotta talk to your person.
100%. Yeah.
Even if it's $100 loan.
Yeah.
Because remember the previous discussion, GDS and TDS ratio.
Yeah.
So the banks will look at that one. And if you want the best possible terms and rates and everything, then you better stay in good terms of the bank.
Exactly. Yeah. Stay within the guidelines. Yeah.
What is the biggest mortgage myth that you would like to delete from the internet?
Oh, man. So the biggest mortgage myth people think that I always get wrong is that you need 20% down payment to buy a house. Whether it's your first house or second house, but usually they always get it wrong after buying the first house. People always think they need 20% to buy a house, and you don't. So I would delete that myth. You can buy a house with less than 20%, even if it's your second house or a vacation home. There's a lot of different options out there.
So every year there is something in air. What popular online advice should Canadians ignore this year?
Oh my God, man, that's a tough one. I see a lot of stuff. I see a lot of stuff online. I always tell people it's not that you need to ignore anything, one specific thing. My advice is always do your due diligence, right? So you see the one clip or you see the one snippet, doesn't mean it's true. Just because it's online doesn't mean it's true.
Yeah.
You need to actually look into other cases, whether or not this is true. Talk to an expert.
Yeah.
Right. I think that's my advice,
Yeah.
A lot of times people will just want something, but I just say, talk to a few different experts.
Do your due diligence.
Yeah, exactly.
Not just rely on one piece of info.
I saw this thing on Instagram or I saw this thing on YouTube, and it's like, like there's some truth to it.
Yeah.
Right. Always. But maybe it doesn't apply to you.
And what is the, mortgage fraud in plain language? I think we touched a little bit on this. How people can avoid getting into this thing?
Yeah. So I think the number one way to avoid it is to, when you get approved, even if you're getting pre-approved or anything like that, you should get some sort of approval certificate. Okay.
A written letter.
A lot of times what I find, the reason why people fall into this trap is because, my mortgage person said I'm approved, I'm fine, everything's okay.
But they haven't
actually received anything, right? And process or if you did an application would generate some sort of a letter.
Gotcha.
Approval letter, whatever it is. So get a letter, right? Ask the question, has this file been adjudicated? This is a good question you can ask.
What do you mean by adjudicated?
Adjudicated means, or has this file been underwritten? You can ask that question. Okay.
Which means it went through the full process as if you bought a property.
Correct.
Gotcha.
That's the key. Now, if your lender tells you yes, but they haven't done that, then they're just lying to you. Okay. And so this is how people fall into this trap. They take their word for it. They go buy a house. And then after the person buys the house, that's when the lender actually starts the work, because the lender doesn't want to work for free.
Yeah. And they don't know whether this guy's going to do work with them or not.
They could do all the work for the pre-approval.
Yeah.
And then the client may not buy a house.
Yeah.
Or may not proceed with them.
Yeah.
And so as a lender, they may say, you know what? I'll do the work when they actually buy the house. Yeah, you're good. You're approved, right?
But now the client is emotionally connected to the property
They've already bought the house, and then the lender says, I cannot approve you.
because you have this debt or
X,
that
Y,
debt.
this debt or that debt, or like
Yeah.
this thing. They didn't actually do the work.
Because he didn't actually see
Yeah.
the actual income,
yeah.
expenses, and everything.
They didn't actually do the work to have the file underwritten. And so this is where I feel like people get stuck and trapped.
Yeah.
And then they have to, do something they shouldn't do.
And if you had to start over in Canada with 25,000 saving, with 680 credit score, what is your 90 days plan? Tell me step by step.
Well, first, 25,000 is great.
Yeah.
You can buy a house for $500,000 with $25,000. Plenty of money. Credit score is fine as well. My 90-day plan would be to if I'm looking to buy a house, is that the question?
Yeah.
Like,
What is the step by step plan for me to become a homeowner in 90 days?
Perfect. Yeah. So first thing you want to do is talk to a qualified lender.
Yeah.
Get approved. Right. That's what you want to figure out. You want to figure out your budget, because what's your income? What's going to be your budget? What's going to get in your way?
Yeah.
Is it your debt to service ratio? Is it your GDSR? Once you figure out what you're approved for, second step is work with a qualified realtor, right? Or work with those two together.
Yep.
And then within 90 days, I guarantee you just have to follow those two steps.
Yeah.
You'll find a house within 90 days.
Yep.
Get approved, connect with a qualified realtor. Once you're approved, start shopping. So you're approved and you're confident. And don't spend the money. Keep that $25,000.
Don't add any extra debts.
Don't
Tap into these debts.
That's it.
And if someone watching this at 9 a.m. tomorrow, what is the first action they can take?
Honestly, this is a good question. First action they can take tomorrow at 9 a.m. is any action. Any sort of action towards your goal. The biggest thing that helps me is taking action. And so taking any sort of action is better than inaction. Okay. Success, real success, sustainable success is achieved through many small actions.
Yeah.
Not giant leaps. And so I always remind myself, even to this day, because I haven't achieved yet what I want to achieve. I'm not going to achieve it in one leap.
Yeah.
And it takes years and years of small actions.
Yeah.
But taking no action or inaction is not going to help you at all. So my advice would be 9 a.m. tomorrow, take some action, write a note of what you want to do.
Maybe they can start with this 3.
Exactly. 70, 20, 10.
Yeah. Or how much are you spending on each bucket?
Correct.
You can start writing.
Do your own budget.
Yeah.
Do your own budget,
Yeah.
I think that's the one. And the only other thing I would say is self-regulation. That's one thing I always think is important.
What do you mean by self-regulation?
So let's say you're doing well, right? You're performing at a high level. You're good in your industry. You're good at what you do.
I'm making good money.
Exactly. You think everything you're doing is perfect because you're doing well.
Yeah.
You're marketing all this stuff. How do you know if you're not doing well? And who is there to tell you that you're not doing well? If everybody around you is saying you're doing well, who is there to tell you you're not doing well? Nobody. So you have to self-regulate.
Gotcha.
So what I do from time to time is I write down goals. I write down goals, 30-day goals, 60-day goal, 90-day goal. So right now we have a 90-day goal we're working on with a group of people.
Yep.
Right? We have a goal.
Yeah.
We're trying to achieve. We're going to know along the way, you stop at 30 days and see, am I on track to achieve this goal or not?
Yeah.
So you have to self-regulate, because what I find that over time is, if you may not have, because these are your own goals, whoever is watching this, you've set a goal for yourself. These are your own goals. So other people don't know whether or not you're achieving these goals or not.
Yeah.
But if everybody's just saying, yeah, you're doing well, you start to believe that you're doing really well, and you have nowhere to go back and regulate yourself. So I always self-regulate. I write down some goals and I go back and see, did I achieve these goals? What got in the way? And how can I overcome these challenges next time? Because again, small actions.
Yeah. So that's a lovely advice. So let's get into some rapid round.
Yeah.
Quick.
Oh man. Okay. Yes.
Yeah. Just one line answers, and only you have one question to pass. You have to answer rest everything in one line.
Okay.
Biggest mistake at the lawyer's office?
Oh my God, biggest mistake. They're not. They don't register the title in the right name. Misspell the name.
Title insurance.
I think must have.
Biggest surprise at the renewal.
You didn't prepare for the rate change.
One thing to stop doing 60 days before applying.
Stop applying for credit cards and loans or lines of credits.
Newcomer with no credit. First product to open.
Bank account and credit card. Both.
Biggest myth in the mortgage industry.
Rates are forever, or you need 20% down payment to buy a house.
Thanks for those quick answers. So just a couple more questions I have for you before I let you go. I know it's a long one, but
man,
I'm pretty sure
I'm having a great time.
What did becoming independent teach you about risk?
Yeah, so I think becoming independent taught me that if you believe in yourself and you have the right skills and the right mindset, you can achieve anything, really. The key is you have to stay consistent. That's the key. So I think if you take any risk on in life, I think you should know that it's not going to be easy. You're going to have challenging moments, but if it's meant to be easy, if it's supposed to be easy, everybody would do it and everybody would be successful.
100%.
So the thing about taking on risk is, what I learned is, it's not supposed to be easy. I still don't think it's easy. I think I have many challenging days and weeks and months. And I always remind myself that if it's supposed to be easy, everybody would do it and everybody would be amazing at it. And everybody would be a mortgage lender.
It's been a great information. I know we will continue to talk. If we talk, we'll talk for another whole day.
It could be the rest of the day.
Let's leave the rest for future
another
talks.
Episode.
Another episode. So where people can find you, brother?
Yeah, you guys can find me online. So on Instagram, my handle is themortgage.mastermind.
And we want all our guests, so as you're the first guest, to leave one question for the next guest that is related to growing financially. What question would you like to leave for the next guest?
Okay. All right. That's a good one. So the next guest, I want to know if they're comfortable sharing. What is their biggest financial blunder and what was their biggest financial success?
Perfect. We will get to know on the next episode. With that, thank you so much for watching us all the way here. I would love to hear more, feedback from you guys. What kind of topics you want me to touch on that will help you to clear off your roadblocks and help you become a millionaire. There is, many average people are becoming millionaires with just the right mindset, right tools, and right education. Hit that subscribe button and follow us, because that will help me to bring more guests who can share more value for you. With that, thank you so much. And thank you so much, Pritish Bhai, for sharing a lot of valuable information.
Aditya. Thank you.